This is Namrata Singh. Today I'll be talking about mutual funds. We have all seen the mutual fund Sahi Hai ad campaign. We have also heard the disclaimer, mutual fund investments are subject to market risk. Please read the offer document carefully before investing. Now let's understand what mutual funds are, whether they are actually Sahi, and what are the risks associated with it. Mutual funds are a pool of money managed by a professional fund manager. There is a common misconception that mutual funds only invest in the stock market. Through the mutual fund route, one can invest not only in the stock market but can also access bonds, gold, and even silver. The market regulator SEBI has divided mutual fund schemes into 5 broad groups: equity schemes, debt schemes, hybrid schemes, solution-oriented schemes, and the others. The equity scheme will include large cap funds, mid cap funds, small cap funds, and the various other categories of equity mutual funds. The debt schemes will include liquid funds, short duration funds, long duration funds, and various other categories of debt mutual funds. The hybrid scheme, which is a combination of debt and equity, will include the hybrid funds, the dynamic asset allocation funds, and the arbitrage funds. The solution-oriented schemes will include the children's fund and the retirement fund, and the other schemes will include index funds, ETFs, and various other fund of funds. As investors, we need to select schemes that will match our investment objective. So say for example, I want to create an emergency fund for myself. I will invest the money into a liquid fund. Now why a liquid fund? A liquid fund is very safe. It has an average maturity of 91 days and I can get the money in a day's time. Now at the same time, if I want to fund my retirement corpus, I would select a combination of mid-cap and small-cap schemes. The schemes we select will also depend on our personal risk appetite. We will try our best to explain various nuances of these schemes in the next few weeks. What are the risks associated with mutual fund investments? The returns are not guaranteed. So if you're looking at guaranteed returns, mutual funds are definitely not suitable. The returns are volatile. They are not linear like fixed deposits. Both equity mutual funds and debt mutual funds have shown volatility in returns. One can also suffer losses by investing in mutual funds. Equity mutual funds show negative returns at time of corrections. Debt mutual funds can show negative returns in case there is a default in the underlying papers. What are the advantages of investing in mutual funds? Professional management is one of the most important benefits of investing in mutual fund. A mutual fund is managed by a money manager who has the expertise and the resources to buy, sell, monitor, and rebalance the portfolio to meet the scheme's objectives. Mutual funds are well regulated by SEBI. SEBI has laid down stringent guidelines for investor protection, transparency, and risk mitigation. Mutual funds offer risk diversification benefits. Through a hybrid scheme, you can invest into both debt and equity and hence not put all your eggs into one basket. Investments into mutual funds are low cost. Because of huge economies of scale, the expense of each fund is very low. Mutual funds offer great liquidity. You can redeem your investments and get the proceeds into your bank account in 3 to 4 business days for your equity investments. For debt, it comes next business day. Mutual funds offer great affordability and convenience. You can start your mutual fund investment journey by an amount as low as ₹500. I started investing into mutual funds in 2007. The journey so far has been extremely rewarding. The positives definitely outweigh the negatives. I have seen the industry change for the better. There are currently 42 asset management companies managing about 39 lakh crores. The industry has grown 5 times in the last 10 years. Mutual funds सही है और ये और भी सही हो जाएंगे in case we invest as per our risk appetite and invest into schemes that match our investment objectives and goals.